Viewers, once again to my channel. Today together we are going to cover how to consolidate a foreign subsidiary as it is covered by IAS 21. Let me stress that there are many ways of consolidating a foreign subsidiary, but I will show you one simple method that when you practice it, it will yield good results. Before we start doing the consolidation, there is assumed knowledge that is required from you. You have to know what is a presentation currency. You have to know what is a functional currency. You have to know what is an exchange rate, what is spot rate, what is closing rate, what is an average rate, what is historic rate, what is translation. You are also required to know the format of financial statements and how to calculate goodwill. Now let's go to the steps of consolidating a foreign subsidiary. Steps to consolidate a foreign subsidiary. Step number 1, translate the financial statements of the subsidiary. Step number 2, post-acquisition reserves are a balancing figure. Step number 3, calculate goodwill using both the currency of the subsidiary, that is the presentation currency of the subsidiary, and the currency of the parent, that is the presentation currency of the group. Step number 4, translate goodwill at each year end and get the gain or loss on translation of goodwill as a balancing figure each and every year. Step number 5, translate the closing net assets of the subsidiary using the closing rate and deduct the opening net assets at the opening rate and deduct the profit for the year using the average rate. The answer will either be a gain or a loss on translation of net assets. Step number 6, calculate the share of post-acquisition reserves attributable to the non-controlling interest. Step number 7, proceed to consolidate the foreign subsidiary line by line. Now let's put these steps into action. We'll be continuously reviewing and coming back to this slide. Now let's do the step number 1, translating the financial statements of the subsidiary. I will use question 6 from CIMA F2 May 2013 exam. We are given extract of the financial statements of A and its subsidiary B are presented below. A is the parent, B is the subsidiary. We are given this summarized statement of comprehensive income for the year ended 31 December 2012 for A, the parent, and B, the subsidiary. You see A uses the A dollars where B uses the B dollars. Check, these are two different currencies. There is an A dollar and a B dollar. We are given the summarized statements there: revenue, cost of sales and operating expenses, profit before tax, income tax, profit for the year, other comprehensive income, item that will not be reclassified to profit or loss, revaluation gain on property, net of tax, total other comprehensive income. We are also given the statement of financial position, property, plant and equipment, investment in B, that is the consideration used to purchase the stake in the subsidiary B, current assets, equity and liabilities, equity, share capital, reserves, total equity, current liabilities, total equity and liabilities. Let's go to the notes. A, which is the parent, A acquired 80% of the equity share capital of B, which means the NCI is 20%. On 1 January 2010, which is the acquisition date, for 1.8 million A dollars. This is the consideration. When the reserves of B were 1.9 million B dollars. This is the pre-acquisition reserves of the subsidiary in its own currency, that is B dollars. The investment is held at cost in the individual financial statements of A. There have been no issues of share capital since the date of acquisition. The group policy is to value non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest of B was $410,000 at the date of acquisition. This is NCI at acquisition, valued at the currency $8. That's the presentation currency of the parent. I want to stress that NCI can be valued using two methods. That's the fair value method and the proportion of net assets method. The fair value method means the NCI should have also the share of goodwill. It should also have the share of the impairment and also the share of the loss on translation of goodwill. Point number 3, the functional currency of A is the $8. The functional currency of B is the B dollar. We have seen this above here on our income statement where I highlighted two different currencies. Then you have to be able to read your rates, how they've put them. They're saying where $8/B$2 means A $1 is equal to B $2. So when you've got $8, it's equivalent to $2B. You have to interpret correctly your rates, otherwise everything will be a mess. You will not be able to earn higher marks if you fail to interpret how you use your rates that are given. Because sometimes you will be required to divide, sometimes you will be required to multiply. If they are saying $A/B$ is equal to 2, it means $1 is equal to 2 B dollars. So if we've got 2 B dollars, we have to divide so that at least we get $8, $1. Now we are given the rates from 1 January 2010, which is our acquisition date. The rate was $8 to B dollars. 31 December 2011, $8 is equal now to $2.10 B dollars. 31 December 2012, $8 is equal now to $2.30 B dollars. Average rate for the year ended 31 December 2012, $8 is equal to now 2.2 B dollars. An impairment review conducted on 31 December 2011 resulted in the goodwill arising on the acquisition of B being written down by 20%. This is an impairment review which resulted in an impairment of 20% of goodwill at the end of 2011. Required, prepare the following for the A group. A, the consolidated statement of profit or loss for the year ended 31 December. B, the consolidated statement of comprehensive income for the year ended 31 December 2012. Let me stress, this other comprehensive income is the most challenging one. If it's not there, everything is just simple and sailing. C, the consolidated statement of financial position as at 31 December 2012. There is a note there. Please round all numbers to the nearest 1,000. Total for question 6 is 25 marks. These 3 requirements, they share 25 marks. Now, let's go step by step. Our first step is saying translate the financial statements of the foreign subsidiary. Now, let's go and translate the statement of the subsidiary. We'll start with the profit and loss. The profit or loss, we have got revenue. Revenue for the subsidiary is 3,000 in B dollars. We have got the cost or sales and operating expenses is equal to 1,800. We sum that up, we get profit before tax. Then we deduct our income tax, which is 400. We sum that, then we get profit for the year. Then we go to other comprehensive income, revaluation gain. For the sake of time, I will be skipping some of the headings, as the assumed knowledge, you know the formats of the financial statement. Now the income statement, when translating the income statement, you have to translate the income statement using the average rate. We are given the average rate, $8 is equal to 2,2. So our revenue will be translated by 2,2, cost of sales 2,2, tax 2,2, gain 2,2. Now we'll say revenue divided by 2,2, because the stronger currency is the $8, the weaker currency is the B dollar. So if we have got the B dollar, we have to divide. We sum that, divide the tax, sum that, we also divide the gain, and we sum that. All these are part of working, and there are a lot of marks allocated to this. PPE. We are now translating the statement of financial position, where the PPE of the subsidiary is 3,500. Then the current assets of the subsidiary, it's 3,000. We sum that. We go to the share capital of the subsidiary. We have got 1,000. Reserves. Reserves, we have to split them from pre-acquisition and post-acquisition. Pre-acquisition reserves, we are told is 1.9 million, so in 1,000, 1.9. Then the reserves that we have here are 3.5. So we'll say 3.5 minus the pre-acquisition reserves. We get post-acquisition reserves as 1.6. Then we have got current liabilities. of the subsidiary, that is 2000. We sum that, 6.5 is balancing. Now, when we are doing the statement of financial position, we have to translate everything using the closing rate, except for the share capital and the pre-acquisition reserves, where we will use the historic rate. So the closing rate for 2012 is $2.30. So we translate everything by $2.30. $2.30. Then share capital, historic rate, that is the acquisition date rate, that was 2. Pre-acquisition, also the historic rate, that was 2. Then the post-acquisition reserves, we said these will be a balancing figure. On our second step, you said post-acquisition reserves are a balancing figure, so we do not translate them. Now let's go on. 3.5 divided by 2,3. 3,000 divided by 2,3. Then we sum that. We get 2826. We say share capital divided by historic rate. We say pre-acquisition reserves divided by historic rate. Then current liabilities divided by the closing rate. Then the total here should equal the total above. It will be 2628. Then now comes the balancing figure, the post-acquisition reserve. Say 28 minus 870 minus 500 minus 950. So the post-acquisition reserves becomes 506, which is the balancing figure. Our statement of financial position is balancing for the subsidiary, translated to $8 in thousands. Now, let's calculate goodwill. We have got the consideration. We are given the consideration in $8, which is 1,800, because it's 1.8 million. And we know the rate at the acquisition date was 2. So now, if we are given the stronger currency and we want the weaker currency, we'll say 1.8 multiplied by 2, we get 3.6. Mind, this column, the E column, is for the B dollars and the G column is for the A dollars. Now, we have got our consideration. Now we also have to put our NCI. We are also given our NCI as $8. The rate at acquisition was 2. Then we'll say 410 multiplied by the rate of 2. We get the equivalent B dollars at acquisition of 820. We sum both considerations. Then now we have our net assets. Our net assets are made up of share capital. Share capital of the subsidiary, it's 1,000 B dollars. Reserves at acquisition, we are told here it's 1.9. We sum them up. Our net assets are 2.9. Rated acquisition was 2. Then we calculate our Z dollars by dividing by $8 by dividing by 2. Reserves also dividing by 2. Then we sum our net assets in $8. Then we get goodwill. Our goodwill will be consideration minus net assets. We get 1520, 1520. Then we do our impairment. Note 4 is saying impairment was 20%. Impairment 20%. When was this impairment? It was December 2011. So we say minus multiplied by 20%. We get 304. Mind this goodwill is at acquisition January 2010. And everything above the consideration is at acquisition, NCI acquisition, share capital at acquisition, and reserves at acquisition. Now, the rate December 2011 was 2.1. So we translate our impairment, 304 divided by 2.1, we get 145. Now, our goodwill end of 2011 in B dollars was 1,216, in $8 was 615. Now we know that goodwill at the end of the year is still 1,216. It needs to be translated by the closing rate in December 2011. So say 1,216 divided by 210. Our goodwill, when we translate it, we get 579. But here, if we say goodwill at acquisition less impairment, we get 615. So the difference becomes a translation loss. The difference becomes a translation loss. Translation loss. That is in year 2011. Then again, we have to translate goodwill at the end of 2012 because that's when we are consolidating. We are consolidating as a 31 December 2012. We have not impaired our goodwill, so we translate at the closing rate of 2012, which is $2.30. So we say 1260 divided by $2.30, we get 529. But as at end of 2011, our goodwill, we reported a goodwill of 579. Now we are saying our goodwill is 529. So it has lost its value by how much? By $50. This is the translation loss year 2012. We are doing all these calculations just because we are asked to calculate, to prepare a comprehensive income. Now let's do the translation of our net assets. Translation of our net assets, we have to take our closing net assets as per our notes here. Translation of, we are now in point number 5. Translate net assets, the closing net assets of the subsidiary using the closing rate, deduct the opening net assets at the opening rate, deduct the profit for the year using the average rate. Then we get a gain or loss on translation of net assets. That's what we are doing now. So, closing net assets. Closing net assets, we go to our statement of financial position. Our net assets of the subsidiary is 1 million share capital, reserves of 3.5 in 2012. So these are our closing net assets, 4,500. Then we translate them using the closing rate, which is $2.30. So we say 4.5 divided by 2.3, we get 1957. Then opening net assets. We translate them using the opening rate. The opening net assets, we have to say closing net assets less total income for the year. We get the opening net assets. So we say minus our closing net assets, we add the profit for the year, we get 3.4. Then this is the opening net assets, that is net assets on 1 January 2012, which are equivalent to the net assets at 31 December 2011. So 1 January 2012 for 31 December 2011, same day, we translate using the closing rate, which is $2.10. So we say 3.4 divided by 2.1. Then now we have to deduct again the profit for the year, which is the total income for the year. The total income for the year that we have subtracted is 1.1. When we sum these up in their original currency, they should give us 0. Then the profit for the year, we translate using the average rate. The average rate is 2,2. Then we divide, get 500. Then we sum all this in $8. We get a loss on translation, loss on net assets translation of 163. Now we have to give, let's refer to our notes. Calculate the share of post-acquisition reserves attributable to NCI. That is our step number 6. Now we have NCI, income statement purposes only. We have got our profit for the year. We are all now using the $8. We have got our profit for the year of 364, and our total comprehensive income. Total comprehensive income of 500 in $8. Now, let's come here. We say total. Our profit was 364. Our total comprehensive income was 500. Now, we have to deduct loss on net assets translation. We know the the gains or losses on the translation of a subsidiary goes to other comprehensive income. So we less it here. They also we say loss on translation on goodwill translation. Here we take the goodwill, the translation of goodwill for the year 2012, not every translation loss, which is 50 because it's for the year, and the income statement is only for the year. We sum up the profit for the year hasn't changed. We sum up the total comprehensive income. We get 364. Now we say the NCA share and the parent share. The NCA share is 20%. So we say this figure multiplied by 20%, we get 73. We also say the same figure multiplied by 20%, we get 57. Now, post-acquisition profits. This is for SFP only. As per SFP, how much were the post-acquisition profits? Let's go to our SFP. It was 506. So we come here and say 506. Translation loss on goodwill for the year, we know it as 50. Translation loss on goodwill. Now let's go and take all the translation losses and also all the impairments that occurred in goodwill from acquisition up to date. First, it was an impairment of 145. We add the translation loss for 2011. We add the translation loss for 2012. So all in all, the loss is now 231. We sum this up. Profit minus the losses on goodwill, we get 275. That's the remaining post-acquisition reserves. We say this figure multiplied by 20% going to NCI. We say that figure multiplied by 80% going to the parent. When we sum that, we should get 275. In this case, we say post-acquisition profits that goes to NCI is 55, and post-acquisition reserves that go to the parent for balance sheet purposes is 220. Then now we have finished our steps. Now we have to go and prepare our financial statements. We will start with the comprehensive income, consolidated statement of comprehensive income. We have our revenue. Our revenue for the parent is $8,008. Then for the subsidiary, we have got 1,364. 1,364. We put them there. 8,000 plus 1,364. Then we have got cost of sales and other cost of sales and operating expenses. For the parent, we have got 4,500 plus For the subsidiary, we get 818 in $8. So we are putting everything in $8 here. So it's 818. Then put them here. 4,500 minus 818. We sum this. We get the profit before tax. Then we less the income tax. The income tax for the parent is $1,008 plus the income statement for the subsidiary that we calculated above is 182. So we say 182. It's 1,000 for the parent, 182 for the subsidiary. We sum this. We get profit for the year. Then other comprehensive income, we have got the revaluation gain. For the parent is $408. For the subsidiary, let's go check. For the subsidiary is $136.8. So for the subsidiary, it's $136.8. Let's put them here. 400 plus 136, get 536. Now we have to put all the exchange losses and the impairment, if any, for the year 2012. Let's go check upwards. We have got a translation loss of 163. We have got a translation on net assets. We have got also a translation loss of $50 on goodwill. Now let's go and put the translation loss here. Translation loss. We have got $50 plus 163. 50 minus 163. Let's sum them up. We've got total comprehensive income of 318. Now we need to share profit that goes to NCI. We have calculated this under our step number 6. For profit for the year, PFY is profit for the year, TCI, total comprehensive income. So we are giving NCI 73. We are given NCI 73. Then the balance becomes the parent share. So we say total profit for the year is 2864 minus 73. The parent gets 2791. When we sum it, it should give us 2864. Then we also come to total comprehensive income. We said the subsidiary gets, the NCI gets 57. So we write 57 here. The parent gets the difference. So it's 3187 minus 57. The parent gets 3138. When we sum them up, it should give us 3187. We have completed. This section is the statement of other comprehensive income. The section above that gives us 2864 is the income statement. Now let's finish off with our consolidated statement of financial position. We have got goodwill. Let's go check the figure for goodwill. Goodwill in 2012 December is 529. Then PPE. For the parent, we've got 6,700. We add the PPE for the subsidiary that we translated above. The PPE for the subsidiary is here 1522. So we come down here, we say plus 1522. Let's put them inside. 6,700 plus 1522. Let's sum them up. Then we've got our current asset. For the parent, it's 4,000 plus. For the subsidiary, let's go check. For the subsidiary is 1304. So let's come here and put 1304. Put them in the appropriate position. Plus 1304. Let's sum them up. Total assets is 14,055. Now let's have the share capital. Here we have got the share capital of the parent. Share capital of the parent is $2,008. Reserves for the parent, we have got reserves for the parent, we have got 8,500 plus the post-acquisition reserves for balance sheet purposes is 220. So plus 220. Just put them in the proper place. 8,500 plus 220. Sum them up. Then NCI. We have got the NCI at acquisition, which is $410 plus the post-acquisition, which is 55. Let's come and put 55. Putting them in the proper position. Plus 55. Sum them up. Now let's have the current liabilities. For the parent is 2,000 plus. For the NCI, let's go check our translation working. That was working 1. It's 870 for the subsidiary. So let's go and put 870 here. Put them in the proper position. That's 2,000 plus 870. Let's sum it up. Our statement of financial position balances. Basically, that's how we prepare a statement of financial position of a foreign subsidiary. Please know these 7 steps. Know these 7 steps, and also be reminded that you can as well download these notes and also the Excel and the PDF documents under this video. Please don't forget to like, share, and subscribe to my channel. Thank you very much.